Hello, everyone. This is Joseph Trevisani from Worldwide Markets. Welcome. Good morning, good afternoon, and good evening, wherever you are in the world. Thank you for attending this webinar. I take it, as I've often said, a great compliment that people take time out of their day to listen to what I have to say. Today's topic is, shall I use a fancy word, multifarious? But its base is going to be the evolution of the world commodity markets and the changes we have seen as to what traders are, how traders, is a better way to put it perhaps, are viewing the commodity markets over the past 10 years, shall we say, and some historical comparisons as well. I've been reading a number of things lately about the rally in commodity markets. You'll have to excuse me, but I suppose all things are relative. If you look at this chart we have right here, this is a 2-year chart, and I'm going to be using mostly the Bloomberg Commodities Index for my discussion of commodities. So this is a 2-year chart. And I suppose you could say that this is a bit of a rally, or was a bit of a rally this year, from the low in January up until right about here a little while ago, early June, and maybe right here you can say in the beginning of July as well. Yes, we did have a reversal of trend. And if you take only the 1-year view, basically, from the peak last June, which is a relative peak, but it was a peak. It came after about 2 quarters of relative stability in the commodity prices. Then you can say that we've had a bit of a rally. It got to the 50% mark on that period, and then it fell off again. Now, from a trading point of view, that's definitely a rally. From a fundamental point of view, let's take a look. Let's, okay. Which one is this? It's global GDP. We don't need that one. US GDP. Okay, here are the charts. This is a 3-year chart with the Fibonacci levels portrayed. Now, you can easily make the case that this is perhaps the real view in commodities, and that this rally barely scratches the surface. It barely deserves the term rally. It's more like a bump. For here, it barely reaches the 23% retracement, which is not one of the ones that we normally count. Normally, the ones that we count are 38.2, the first of. Now, one of the things that's normally true about a Fibonacci analysis of almost any trading market is that over time, given all other things being equal, it returns close to the 100% rally. Let's take a longer look at here. And we can see this is not even remotely true. So for a purely traded rally, we need to have an explanation for this chart, but also this chart. Let's see, that's S&P. That's BCOM. Let me just find the right chart here. Do I have the charts over here? Hold on. Okay. Where's the historical one? Okay, it's not exactly the one I want, but I think I will use it unless I can find a better one, unless I have the better one here. Okay, let's use this one. Sorry about that, folks. I had a long ride into work this morning, and I wasn't sure that I was going to make it on time. I was very wary of traffic. but in fact, there's very little traffic this morning. Not sure why. Okay, anyway. This is a historical. Wait, just one second. Let me make sure I have one from 2010 with the Fibonacci on it. That's what I wanted. I may have forgotten to send that one. It will be a drag. Okay, well, we'll deal with this one. Okay. So we can clearly, let's just concentrate on the white line here, which is the Bloomberg Commodities Index. And let's discount this period right here. Because right here, we're talking about speculative excess on and on in all the markets. We're going to ignore that simply because we're not there anymore. So let us talk about this period here. The 10 from about 2011 down. That is conceivably, and I think accurately, the period that we're talking about for a profound, prolonged move in world commodity prices. Came from almost 180 down to about 72 or so, if I believe. On that chart, on that move, there has been zero retracement. Essentially zero. I mean, not completely zero, but essentially zero. And when we go back to here, go back to the 2-year chart, we can see that whatever recovery there was, and from last year there was about a 50% recovery, it has tailed right back off again, back through the 38th percentile, and headed back to the 23rd percentile. That is not normally the type of recovery you would see after a 4-year decline in commodity prices. Again, let's take a look at the historical one, 1991. Okay, from 1991 till 2000, you could say 2003. 1991 is the beginning of the beginning of this index. You had a large variation in pricing, but you essentially had a market bounded by use. Bounded by, this is US GDP. Let's look at world GDP. Well, let's stay with US GDP for a minute. You can see that the variation, even during the recession of 2001, was relatively muted. The Bloomberg Commodity Index and commodities in general, during that period, were tied largely to use. They had not become the vehicle for massive speculation that they are now. So let's take another look at one that goes into some of these items in a little more detail. And just to show you, this is global. You can see it very much looks like US GDP. And here we go. Same thing. Variation is relatively limited within this period here. And here, what's interesting is you can see that there's a divorce. The commodities index is flailing to the upside from about 2005 on. You could easily say back here 2004 on. And what's happening with world GDP as far as variation goes? Essentially nothing. World GDP, right from here. So this is the main point I'm going to be making here when it comes to this and this entire discussion. About 2004, the commodities index became divorced from the underlying fundamental factors of resource recovery, I wouldn't get that recourse, of resource obtention, no such word, of resource supply and demand. Use a simpler term. Because through this period here, from 2005, where it becomes dramatically obvious, to 2008, commodities are on a market bubble tear. And the world GDP, world use, supply and demand is going nowhere. Now, that's not entirely true, and let me explain how it is. Because one of the things that was going on through that period was the supply side. The raging both investment in resource development and the somewhat fantastical view of China and the developing world as a source of endless, not just use, but endless growth, played a part in this chart. Because you were getting this whole mentality that was divorced from actual demand side information. So we can see from this chart that commodities became an object, an instrument of massive speculation. We can also see that the speculation was not based on actual use figures, at least sustainable use figures, out of world GDP. This is world GDP in the green line. It includes China. And there is a tremendous rise in GDP from here to here. But once you get past about right here, the variation becomes much smaller. Yet the speculation in both commodity prices, which of course drives commodity development, resource development, becomes divorced. Okay, so here we have coincidence, meaning that they happen at the same time. Plunge in world GDP, plunge in commodity prices, bursting of the bubble in commodities, understandably, okay? They both respond for a few years, actually a few months. The scales, proverbial scales, fall from everybody's eyes, and the bubble is recognized, the bubble pops, prices plunge, and on. Here, we have the recovery coincidence. World GDP recovers, commodity prices recover. Not to the bubble levels, but to here, the level that we are through here. And then we have world GDP tailing off, and through this period here, we have sort of stasis. Not really, there's plenty of volatility, but GDP and prices are roughly moving in the same direction at the same time. What happens on the far side after, let's say, 2013? Well, we don't have a lot of variation in GDP. Again, it's varying, but within a very restricted range. But commodities are plunging. And what we're trying to ascertain is why. Now, let's look at it first from the way we looked at it back here, which is that supply ran based on prices vastly ahead of demand. And once much of the demand was realized, the ever rising demand from mainland China was probably overstated. The West has been overstating or misapprehending something about the mainland Chinese, the Chinese market, be it imperial or communist, or a brief interregnum of sort of capitalism, and now it's capitalist again. Actually, it was interesting. I read the biography of Su Meiling. She was Sung Meiling, one of the 3 or 4 Sung daughters. The eldest one married Sun Yat-sen, the president briefly of the Chinese Republic after the imperial dynasty fell in 1912, 1911 maybe. Her younger daughter married Chiang Kai-shek, leader of the Kuomintang, head of most of China in the 20s and the 30s, defeated by the communists and Mao Zedong and company in 1949. Thereafter, until his death, head of the Republic of China, which is still there, on the island of Formosa. The fascinating thing I saw is that Miss Sung was born in 1898 and died in 2003. She was 105. And if anyone, anywhere, is looking for a life of event and fullness, regardless of your judgment on politics of China in the 20th century, what a fascinating life. Anyway, just I'd throw that. She'll be 105, lived in 3 centuries. That is a pretty unusual life. Anyway, back to this. So, we have commodity pricing and commodity levels on the Bloomberg Commodity Index falling to lows actually not seen ever before. Is this because the world economy is collapsing? Well, it may yet, but it hasn't so far. So these prices here, from 2013 on, for the last 3 years, are, much as the prices here are not really referencing fundamental actions, fundamental developments in the world economy. You know, the old line that the cure for high prices in a commodity, or the cure for high prices is high prices, bears very much on commodity markets. If oil, as it was here, is overpriced, what will it do? It will promote development of oil, as it did shale oil, which now dominates the marginal pricing for the world oil supply. And what happens? Well, more oil comes online, the prices fall. Oil, the basic industrial commodity. Part of that has to do with this here. It's difficult to say how much, because many of the resources were overdeveloped as far as the extraction capacity back here. But this is almost 10 years ago now. Nevertheless, a lot of those, certainly in oil, it continued all the way through here, and those resources are there waiting. Oil dropped below $40 a barrel, I think, on Friday, but it's come back to a little bit over 40 today. But I think there's also something else going on. And this is difficult, harder to chart, but the speculative interest, what was driving here? Remember, for certainly the oil price, which looks very much like this actually, the ability to speculate in the markets was driving the oil price. The story of the ICE exchange moving unlimited speculative trading, meaning not tied to resource extraction in oil, to the London exchange, which reverberated back into Chicago and New York actually, and forced the same similar types of rules on the NYMEX. What's the result of that? Well, you got in a speculative bubble, everybody was piling on to one side, of course, the long side. So that drove prices, regardless of their reference, of which there was basically none, or very little, to new heights. And I think we still have some of that here in the disassociation again between, because look what we have here. This period here, a rough and very rough, remember this is world GDP, quarterly, and this is a daily chart. So rough equivalence in movement, rough. What do we have here? Divorce. GDP does not move, prices skyrocket, especially in this period here. What do we have here? Again, congruence. Through here, again, rough congruence, peaks, comes off, commodities peak and come off. But what do we have here? Like here, but on the downside, we have divorce. We have commodities plunging, and oil and world GDP is relatively stable. Okay. Now, are commodities anticipating some sort of collapse in GDP, world GDP? Commentators to the negative have taken this as a warning sign that world GDP is headed for a collapse. Not necessarily true. And the same way that a trading market will give you speculative excess to the upside, there is no reason that a market cannot provide speculative excess on the downside. And when speculative things change, they change in a rush, and they usually change for a catalyst that changes world view, market view, sometimes practically instantaneously. We saw something like that in the euro. I don't have the chart. In the late summer of 2008, I think I've spoken about this before. I know I have. When, after listening to Jean-Claude Trichet and a number of the Europeans say the U.S. subprime crisis has no reference here in Europe and our banks are fine and the economies are fine, they'll not be affected, we're quarantined, whatever you want to call it. Suddenly, or one day, Mr. Trichet said, well, growth is not going to be what we expect it to be quite. And suddenly the euro just took a nosedive. Why? Because that one comment undermined the entire view prior, coming out of ECB and many other commentators, that Europe was somehow disconnected from what was going on in the United States. The idea that one particular part of the world is unconnected from the rest of the world is never true. And when you hear it, you know that something is brewing. It's never different this time when it comes to the impact of the four big economic blocks on each other. The United States, actually, if you take the European Union, that's the biggest economic bloc, followed by the United States, followed by mainland China, and followed by Japan. So keep that in mind whenever you hear, there's that old idea that one of the things that you can monitor if you're looking for a pending fundamental change in the world economy or any particular market is the number of instances, especially this is true of the equity markets, you hear this over and over again, the number of instances that you hear or can Google in the media where commentators are coming up with reasons why this time it's different. So far nothing has proven to be true that no time is different. Okay. So is there a predictive value? And this is one of the themes of what we're talking about here. But before we go that route, let's take a look at some of the relation between the other markets, which became hugely let me just share this one briefly. Okay, so we have here oil in purple, commodities in, or the Bloomberg Commodity Index in white, and this is the U.S. S&P, the U.S. Case-Shiller S&P, I think is it Reuters, home price index. And what I'm looking for is other markets which saw speculative urges at about the same time. And this is one of them. This rise, and this is again my point, this rise, the housing bubble in the US, parallels in time, although it peaks a little before, the commodity rise. Both markets suffering excess speculation or speculation beyond fundamental reality, economic reality, in a similar time frame. What do we see after that? Again, through this period here, these two, of course, the oil being a component of the Bloomberg Commodity Index, you're going to see almost identical movements, and they are very similar, although not identical. So what do we see here? The Case-Shiller home price index has crawled most of the way back to its bubble price peak. What else do we see? There is nothing here, or at least the speculative urge has reversed. It's gone the other way, because from this congruence here, for this period, where all of these three indices were moving in tandem, and you could say here too, although different time frame, and even here too, in this period right here. Not true here. From 2013 on, or 2012 in this case, because the home price moved higher, you have a divorce. So have people simply stopped? Clearly, housing is still being driven by interest rate policies coming out of the Fed. Or you could say by the recovery in employment, which I don't buy, because what's going on through this period here is a decline in home ownership. So if fewer people are buying homes, why are house prices rising? And it is. The U.S. home ownership rate just hit like a 20 or 30-year low very recently, right around the end of this chart here. So if fewer people are buying homes, why are home prices rising? Well, we can all make some speculative guesses. One is that interest rates are still low. 30-year mortgage just reached, again, its all-time low of 3.36 last Friday. I wrote something about that on Friday. Well, that's interesting. The prior low, I believe, was in 2012. But it was when the Fed was actively in the market with its quantitative easing programs, buying securities to drive rates lower. So the Fed was actively out there driving up bond prices and lowering, and it was buying MBS. It was buying mortgage-backed securities to drive interest rates to an all-time low. That's back in 2012. Well, the Fed is not in the market buying MBS, but of course, other people are buying bonds. The ECB and Japan are out there buying, and the Bank of England as well. So even though the Fed is not buying bonds, other banks are. And even if they're not buying directly in the US market, when you're looking for yield, you got to go where the prices are. So if the Fed is not buying, and even if the BOJ and the ECB are not buying in US markets, they're vacuuming up supply in two of the other biggest credit markets in the world, Europe and Japan, leaving far less for anyone else to buy. So what do? They come here to the United States. So that's really what's going on. Even though it appears that the Fed is not buying, it appears that the Fed is not driving this, and in fact, the Fed is not. Nevertheless, central banks still are. So the fact that we are back down at historical lows in US 30-year mortgages is one of the reasons here. Another reason for that rise in home prices is far fewer people are moving. Far fewer people are actually buying homes. But how can prices still rise? Because far fewer homes are being put on the market. And the prices are rising because of that. Anyway, because you have this interesting split. You have the turnover in existing homes, somewhere around 5 million annually, which is about an historical level. It's a little low for the increase in population, but it's not unheard of. It's not outside the realm of a relatively normal market. Yet you have these strongly rising prices. And you have the lowest home ownership rate. These things don't work together very logically. So the idea that the housing market has recovered to a normal state is simply not true. Okay, so you can see again here, from this convergence, congruence here, rising home prices, rising commodity prices, really just, these two are not referencing each other, but they are referencing something on the outside. But here you have a change in that. So this is how you know that these two are not directly connected. So they were, you'd see a connection here. They're not. They're connected through where the speculative money flows. Okay. So now let us look at, this is not a useful chart. Sorry, we just looked at that. Okay, this is going to get a little more complicated for the chart, but I'm making the same point here. This is what we're looking at here. The white line is the Bloomberg Commodities Index. The yellow line is the bond market. It's the yield on the 10-year generic US Treasury. Now remember, bond prices, which I could not find to put on a chart, I could only find the current pricing for US bonds. I could not find on Bloomberg, all these charts are Bloomberg, of course. And I looked for quite a while this morning. I could not find what I wanted, which was a historical record of bond prices. The reason I'm guessing is because bonds price individual issues. And so you'll have a price, much like the contract in the futures markets. And so you have an individual pricing history for a particular bond, but there doesn't, I'm actually going to get on to the Bloomberg chat when we finish this and see if I can find a function like this or build one. Okay, so white, Bloomberg Commodities Index. Yellow, 10-year yield, generic. Green, the S&P, and purple, the Dow Jones Industrial Average. And we're going to see the same thing, a very similar thing that we just saw in the other chart. This period right here, everybody's happy. So what does that mean? That means equities are rising, commodities are rising. Now that makes historical logical sense. Equities are rising because the economy is doing well. The economy is doing well, commodity prices are rising. Okay, so far so good. Then we have the 10-year yield. Now remember, bond prices are opposite. So from this period here, we have bond prices rising. From this period here, as rates go up, and they are rising a bit through here, bond prices are coming off. So it would be coming off here. So that would be what you would expect still. As the economy heats up, which is what a rising equity value will tell you, and a rising commodity value will tell you, you would expect rates to begin to rise in anticipation, prices fall, rates rise, in anticipation of Fed tightening. Okay, so through here, this is the normal sort of congruence that you will find. Now, you can make the argument, and I've made it many times, that the very strong rise in commodities and equities right here would not necessarily tie to fundamentals. Okay, but markets have excess in speculative direction. They always have, they always will. It's kind of the purpose of markets. Okay, so then you have the big divorce and everybody starts coming off. Prices fall, commodities fall, equities fall, and rates fall, and bond prices rise. Rates are falling because the Fed is deliberately cutting, forcing rates down. Let me just, that's an interesting question. Let me work through this argument, and then if I don't, if it doesn't answer your question, then I'll come back and try and deal with it. I mean, it's a difficult, when you say, I'm assuming when you say bull run, you mean the bull run of the equity markets. Okay, so let me deal with that right here in this explanation, because we're going to see here, and then I'll come back to it if it's not answered. So look at this. Again, this is the same type of item congruence that we saw earlier. Everybody's happy here. And here, again, right here, we have a similar, but here we have this huge divorce. Huge. We have enormous speculative rise in equity prices. What is going on here? We know what's going on, but let's keep going. We have commodities coming off. I mean, if there's a fundamental aspect to commodities coming off, it's that the world economy is not doing well. They don't need as many commodities. Also that, and we know this is true, that there was overdevelopment in many resources, which brings the supply up, which plunges prices, of course. But here, this is the peculiarity that there's been no worthwhile explanation for, except, which the Fed denies, well, not really. They will admit it, I assume in private, at Fed cocktail parties. They're all cheering what's going on in the equities markets. But there you have the fundamental divorce in the world economy right now. You can say for the past, I would say for the past 4 years, right? We're 2016, it's 2012, right about here, things start to go, or right about here, things start to go haywire. And what is going on there? Well, we know what is going on there. It's the advent of quantitative easing in the United States, thereby leading the world down the path of zero to, which has led us to zero and negative interest rates. Through that period there, we have a dramatic rise in equity prices, largely divorced from economic growth factors. I've heard arguments many times, mostly from equity promoters, of course, that that's because corporate profits were so strong. Well, corporate profits were strong, relatively speaking, in that period, not because of fundamental sales growth, but because of buybacks and cost cutting, by and large. At any rate, we have, as we can see, dramatic, profound rise in equity prices. Well, if the economy is doing well, what do we look at? Well, we're assuming more growth, more sales, more use of resources. But what do we see? We see a steady, volatile but steady and sharp decline in commodity prices. Somebody is not using this stuff. Even granted the oversupply. Because I said earlier, the cure for high prices is high prices. The cure for low prices is also low prices. As the prices fall, capacity goes offline because people can't make any money mining iron ore in the middle of Australia anymore. Capacity goes offline, prices go back up. That's not what we're seeing so far. Something else is at play here. And the great warning sign, which I believe to be true, is bond yields, the credit market. If the world economy is doing so well, what are bond yields doing down here? In a normal cyclical business world, bond prices and equity prices are counter-cyclical to each other. It's not what we're seeing here. So again, to get back to your question, what we are seeing is an artificial reduction in the yield curve, also to some extent a flattening of the yield curve for the past 4 years. We are not seeing, which I think is the point of your question, Dion, the normal counter-cyclical waves of the pricing in the equity and the bond markets. Equity prices go up. That means the economy's overheating. What happens? Bond prices start to fall because they're anticipating a counter-cyclical move by the central bank or banks to raise interest rates so that the economy does not overheat and we do not get inflation. This is the traditional mollifying, if you will, role of the central bank. That is not what we're seeing here. In fact, commodities and interest rates are predicting the same thing, and it is opposite what equities used as a discounter of future economic growth are predicting. David Stockman, the former Reagan budget director, 30 years ago, had a phrase which caught my eye. And he said that the only thing that the equity markets are discounting is monetary cocaine. And if you look at this chart, you can see the origin of his macro idea. Because these are macro trends we're talking about. But they're macro trends which are being interfered with by the interest rate policies of the world's central banks. No, I don't think they're not just manipulating the front end, they're manipulating the entire curve. The entire curve has been repressed across the entire spectrum, from overnight to 30-year notes. Is anybody offering more than 30-year notes these days? I'm not sure. The entire thing has been repressed. So if you had a combined yield curve, you would see that the absolute level is far lower than would be predicted based on any historical models. Okay, now let's take a look at another indication of the same thing. Okay, now gold is in green. I guess I should have put it in gold, but I didn't think of it. And the commodity price index in white. And again, divorced in time, meaning they're not necessarily moving at the same time, but within a certain level, the movements are the same. Okay? Here, everything's hunky-dory, but not everybody believed it. And one of the things that the people were focusing on at the time, perhaps, was inflation. Gold is a hedge against inflation. Okay, gold price over here, of course. So we have a crash, and interestingly enough, if you look here, as commodities come down, gold came down too. But nobody knew what they were dealing with here. Turned out to be much more serious. So suddenly, one other aspect of gold shoots up. The Armageddon side of gold and the trading side of gold. Meaning that people are worried about the end of the world, they buy gold. What good it's going to do them locked in their basement or locked in a vault someplace, I don't know, but people buy gold. Nobody ever truly anticipates the end of the world unless you're writing fantasy and science fiction novels. Okay, so you have a strong rise in gold up to the peak here. And then you have, again, a similar type. As commodities come off, gold comes off. So what's going on through this period right here? Well, things are calming down, and inflation is not arising. So the two of the reasons, and actually a third reason is, of course, trading, for buying gold all start to tail off. But here, interestingly, is this. If a rise at this period here, right about here, right, which is the beginning of 16, which is the beginning of 2015, not that long ago. We were all a little bit younger, but not a whole lot younger. If commodities, if this is a typical commodity rally, we've turned the bottom in economic decline, commodity prices are coming back up, and we're going to start using commodities more, and so therefore commodity prices will go up. Makes perfect sense. It would also mean that we're returning to normality, perhaps, in the world economy. Therefore, you would expect that desire for gold to tail off. Does this mean that we're returning perhaps to a more inflation-oriented environment? I mean, perhaps you can make that argument. We haven't seen it really, but at least as a forerunner, you could certainly take that position in gold. But the decline in commodities since the past, since June, I guess, has not really been mirrored by a decline in gold. So the use of gold is giving you a different sign, but really it's not. It's giving you, it would appear to be giving you a different sign, but in fact, it's giving you the same sign. If this decline here means that we do not have a normal commodity price rally, that yes, what's going on here is you have a reaction to this, basically nothing more than profit taking. Its fundamental role is divorce. Now, is this 6-week fall in commodity prices purely an indication of that? There's absolutely no way to tell, at least just from this. This could easily be nothing more than a retreat from people who went long down here and doesn't mean anything necessarily at all. Is this a reversal of trend? The only thing we know is that it is a reversal of this trend. Is it a reversal of this trend heading back up here and this trend over here? We have no idea. We'll find out. But one thing that I think is definitely true is that gold is trading, at least for the past 6 weeks, largely opposite the movement in commodities in general. Meaning that something, and I would say it is concerned for the world economy, is driving the gold price higher. It's certainly not concerned about inflation. I don't see much inflation anywhere. So in a way, these two charts are reinforcing what we saw earlier. Okay, we just did that. Let me do one more chart and then we'll see if there is anything that, okay. Now I'm gonna just start, that's actually not, I don't want to do this one. I think I forgot to take one chart with me today that I really wanted to. Okay, where's the 3-year on this? Where's the 3-year become 3-year? Okay, this is the recent high in the commodities indexes. Come on, give me this. Where is it? Okay, here we go. Okay, and then we will see. We'll just wrap up here. Let's take a brief look at this one. If this is a rally based on prices, it did not come, and on profit taking, it did not come anywhere near the normal type of recovery from a rather profound fall in prices. So if this got started as a profit taking rally, something short-circuited it. Because normally on a fall like this over this period, forget about the more difficult, the larger one from 2011, you would see a return at least to here. Now, we may yet, but something short-circuited that rally. And rallies never move in one direction. They do stuff like this right here, you know, so we know all sorts of stuff is possible. But it's certainly true that something short-circuited this rally. We could say it coincides with the Brexit vote. Actually, it starts down a little bit before the Brexit vote. If we're August here, then let's see, January, February, March, April, May, June. You could say it coincides with the Brexit vote, which took place right about here. Okay? So we know this is not simply a price recovery rally. So something else is going on here. Let's look at this again and then draw some conclusions about what we are seeing here. That's not the one. That's just WTI. Okay, that's the one. Okay. So the question before us, and it's not just before you and me, it's before all of the world's central banks. They have these same charts. And whatever I mean, I've never worked in that kind of bureaucracy. I've worked in a bank on a trading desk, which has limited bureaucracy. So I'm not sure how the urge to defend the bureaucratic view and what is both permissible and possible under a bureaucratic restrictions changes your worldview. Meaning, if you can only do certain things because of your bureaucratic position, then does that color your worldview as to these are the proper things to do? My guess would be absolutely. People are captured both intellectually and emotionally by their position and what it means and how to view the world through their position. So looking at this chart and many other charts, but particularly if you compare this to a GDP growth, it would seem to be patently evident that low interest rates at the zero bound do not promote healthy, sustaining economic growth. They do promote speculative excess in various markets. So the question we have to look at is which side of this chart is correct, the two equity averages or the commodity average and the interest rates. It would be my contention, and I'll leave you with this, and you all know where I'm going to go with this because you've been to many of you have been to my webinars before, that it is the equity, it is not the equity, to put it in the positive terms, that the interest rates and the commodities are giving a more accurate picture of where the world economy is and where it's headed than that very sharp and now sustained rise in equities. Okay, folks, I thank you very much for attending. I hope this has been useful in some fashion. I did get some suggestions after my request last week for a webinar topics. I only have one more week of webinars before I go away for summer vacation. I join my two girls and my wife, which I'm looking forward to. So when I come back in the fall, I will be taking up some of those topics that you also kindly suggested. Once again, I thank you all very much for attending. I hope this has been useful. I will put my email address up there if you have any suggestions or questions or suggestions for further future webinars, please let me know. I hope you all have a great remainder of the summer, and we will see you, or winter if you're in the Southern Hemisphere, and we will see you next week. I'd like to thank FX Street, Adinda, Maurizio, Francesca, and the rest for all of their efforts, and we will see you next week. Thank you much.